It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Managing Your Financial Future, we are back with yet another episode, podcast time. Thank you all for joining us. We do appreciate you being here. I'm your podcast host, Johnny Dean, here with my good friend, Professor Rick Plum.
Good afternoon, good morning, good evening.
That's right. CFP, Certified Financial Planner Professional. I really appreciate you being here. This is fun stuff that we're going to be talking about today. I got to tell you. Not so much because we've talked in the past about the classic 60-40 balanced portfolio,
Right.
Skim some off the top every so often and then rebalance and all that stuff. But I ran across this particular article in the Wall Street Journal, and I thought, well, I got to talk about this with you. And the headline said the classic 60-40 investment strategy falls apart. There's no place to hide.
Well, we have had an interesting year where both stocks and bonds basically took it on the chin.
Well, it's exactly what happened. The subhead says a savings mix of stocks and bonds has helped offset losses in previous years, but not this one. And we've kind of talked a little bit about this in previous episodes, but we haven't really focused as much on it as we normally have. Now, let me just read a very little quick 30-second passage from this, if I may, and I'll have you comment on this. And then what we're going to do is we're going to get into the idea of, well, if bonds aren't going to be your safety net, quote unquote, then what are you supposed to do? So we'll get into that in a second. But this says, for decades, Americans planning for retirement have been advised to invest in a mixture of stocks and bonds. Right?
True.
The idea was simple. When stocks did well, their portfolios did too. And when stocks had a bad year, bonds usually did better, which helped offset those losses. It was one of the most basic, dependable ways of investing used by millions of Americans. But this year, it stopped working.
Interesting. They're basically phrasing it as if this is the first year
It's not.
that a balanced portfolio has ever gone down.
No, it's not. But it's one of the only times. Well, I mean. In normal, quote unquote, normal times, you're going to see bonds take the hit or bonds come to the rescue. I don't like to use that phrase.
Well, they kind of buoyed the downfall. I mean, we go back to 2007, 2009.
Right.
And the average balanced portfolio at that time was down, like 25, 26, 27%.
Right.
Well, that's because the stocks were down 40 and the bonds kind of held it up, a little bit. It kept them from falling all the way down.
Well, what they said was, despite a powerful rally last week, and again, this is from mid-November, so I don't know when you're listening to this, but despite a powerful rally last week after cooler than expected inflation data, the S&P 500 is down in 2022, down about 15%, including dividends, while bonds are in their first bear market in decades. A portfolio with 60% of its money invested in U.S. stocks and 40% invested in the 10-year U.S. Treasury note has lost 15% this year. That puts the 60-40 investment mix on track for its worst year since 1937, according to an analysis by the management firm Leuthold Group.
That sounds reasonable. We have had a perfect storm for stocks and bonds going down in value. We had interest rates rising, which just hammered bonds. And people were in the bond portfolios were looking for yield. I mean, for a long time, yields were in the tank. We couldn't get yields. We couldn't get any interest being paid. And so people, unfortunately, tended to go out a little bit longer on their maturities to try to get a little bit better cash flow, thinking that, well, for the last 10 years, we've been pretty stable, pretty steady on our interest rates. Very low.
Yeah.
And then this year, they went up quite a lot comparatively and quite quickly.
Well,
and when that happens, bond values go down.
Yes. When interest rates rise, the value of your bond falls.
I mean, a year ago, what was the 10-year Treasury? Two-ish? 2.5?
A year ago? I thought it was lower than that, but maybe.
Maybe cut 2.
I don't know.
And now it's just under 4.
So it's doubled.
So a 2% increase.
Yeah.
And you look at that and say, well, I bought a 10-year bond 2 years ago. I've got 8 more years for it until it matures. I'm losing 2% a year to current interest rates. So if you look at very easy, this is not exact math, 2% times 8 years, I'm losing out on 16% of interest. Therefore, reality is my bond is down like that 15 or 16% because a new investor is going to want that 4% cash flow or 4% total yield, total return.
Well, and listen, this is what else they say. Bonds have helped offset the pain of previous market crises, including the bursting of the dot-com bubble in 2000, because interest rates were higher.
Right. Well, everybody just, they were so afraid of the stock market, they just went to the bond market and they were bidding the heck out of them.
Right.
They were buying them up.
Including the bursting of the dot-com bubble in 2000, the global financial crisis of 2008, which it did, and most recently, the brief but punishing bear market brought about by the pandemic in 2020.
Brief being the operative tune there. I mean,
6 weeks, 8 weeks,
it
I don't know.
did not take very long.
No, but it ended at like an 11-year run. I mean, it was 11 or 12-year run.
Bull market.
Well, sure, yeah. Okay, so this year, they said, this is again the Wall Street Journal article, this year, U.S. Treasuries are having what could wind up being their worst year going back to 1801, according to Lloyd Hold, as central banks have swiftly raised interest rates in a bid to quell inflation. I don't think it's going to work, but whatever. Again, this is mid-November. I mean, but I'm saying this is where we are or were at this particular point.
And we don't know if it's going to get any better because the Fed has said that it's going to continue to raise rates, at least on the short end.
Right.
So we'll see what happens. But bonds are, we've always known that if interest rates go up, bonds are going to get hurt. We've had the greatest bull market in bonds for the last 15, 20 years when interest rates, or 40 years, when interest rates have been coming down. That's been just the greatest bull run for bonds, I think, ever, because interest rates went from where they were in the 80s, early 80s, to where they were in 2018, which was like nothing.
Right.
And so that's good so they had to go up at some point. I guess most people just didn't expect it to go up quite as quickly as it did this year.
Well, okay, so this gets back to, I won't get into the whole, they made a good, they made a point about the 60-40 investment strategy being not always what you expect it to be.
Well, on a year by year, 2, 3, 4, 5 year period of time, they may not perform, as positive results. I mean, that's unfortunately what happens. We saw that happen even in the financial crisis, 2007 to 2009. Even a good balanced portfolio went down, and it took several years for it to recover to where it was before. But over a 7, 8, 9, 10 year period of time, the balanced portfolio did what was expected. If you were a buy and hold investor. But the problem is when you turn it into, this is my portfolio that I'm going to use for distributing cash to live on.
Well, then
that's where the real problem comes in.
Yeah.
When you're looking at it, and I want to take my 4% rule, distribution out of a portfolio that has that kind of volatility, whether it be, any kind of portfolio that has volatility, you run the risk that things go against you.
Mm-hmm.
And when that happens, now it's not a 4%, it's a 5, 6% distribution. And then if it keeps going down from there, you tend to get very emotional and you sell when it's already down, and then you got no chance of recovery. So it's a poor situation for a distribution portfolio.
Well, the funny thing is, if you look back at interest rates being so low, and yes, everybody was pretty much lulled into a sense that, well, they're going to be low forever because interest rates have been this low for well over 10 years.
Yeah.
10, 12 years. So people thought, well, that's just kind of the way it's going to be.
That's the new norm.
But if you look back, you got to think, well, wait a minute, it seems obvious. It should have been obvious that interest rates were going to come back at some point. So wouldn't somebody's portfolio be better suited with that information in mind? Now, granted, as I said, 10 years, we thought interest rates were going up in 2013 and again in 14. And, we've heard this over and over enough to think that, well, it's not going to happen. But we knew it had to happen.
At some point.
At some point.
It was unrealistically low.
Right. So does that mean that do you believe somebody's portfolio should have been set up in anticipation that interest rates were going to rise?
Well, you always have to have that in the back of your mind. Even when interest rates are where they are today, you have to be under the idea that if interest rate rise, what is it going to do to my portfolio? If I have a balanced portfolio, if I have a fixed income portfolio, what is going to affect it? And is there anything I can do other than this? Now, like I said, over a 7, 8, 10 year period of time, a balanced portfolio will likely do better than a straight bond portfolio.
Yeah.
But it should do fine for that period of time, unless you're taking distributions. So how do we build it in? I mean, you don't want to necessarily for some of your money, take the risk of the pure stock market, because the market can be down more than what the bond market is. Although this year they're kind of the same. That's the anomaly of this year.
Exactly.
But I don't want to take that risk, so I want something midterm. Balanced portfolio still works for midterm, 7, 8, 9, 10 year time horizon. I just don't think that they work, and I don't think they ever worked for a short-term time horizon. Again, we're getting back to what I believe in, asset and liability matching. Match your assets to your liabilities. If I have a liability, meaning I want to spend some money in the near term, I should have a short-term asset for that. A long-term bond ladder, an intermediate-term bond, does not fit that. By definition, it's an intermediate or a long-term investment. It's in the name, for heaven's sake. So if I want a short-term need, I want a short-term investment. Midterm, okay, that's where a balanced portfolio could work, but there may be things that make you feel better now in today's world, because we can get we can lock in some rates either through individual treasuries or fixed annuities and things of that nature. Oh no, I just said the A word.
Wow, are we going to have to bleep the annuity word? Is that? We'll get into that in just a second, because that's going to be part of what we're talking about today.
But it goes back to matching your assets and your liabilities, and don't use a mismatch there. Don't use a long-term asset to fund a short-term need.
Now, we're talking, there are two different stages of this. The one is the accumulation phase, where you may want to use one type of strategy, but then we need to probably switch strategies when we get to the distribution phase, right?
But even when you're in the accumulation phase, as you get towards the end of it, you're going to be paring back on the aggressiveness of your overall portfolio.
Mm-hmm.
But that doesn't mean 100% of the portfolio. That means some of the portfolio. Because even when you're 65, and when I get into retirement, it doesn't mean that 100% of my portfolio is conservative, because I may be 65, 70 years old. Maybe I'm 75. I may make it to 90, 95, 100. Some of the money can still be invested for longer term. I'm not going to spend every penny I have by the time I'm 80, especially if I think I'm going to live until I'm 90. So you have different time horizons in your portfolio, regardless of where you are. I mean, if I'm 20 and it's an IRA or 401k, yeah, okay, that's long term. I mean, that's kind of the way it works. Yeah. But if I'm 55, maybe some of that money is midterm and some of it is long term.
Yeah, so you need to be thinking.
When I'm 65, some of it should be short term, some should be long term, some should be midterm.
Well, what you just killed was the rule of thumb that says, how much in stock should I own? Well, let's see. If I'm 90 years old, I should be 10% stock and 90% bonds.
Well, I think that a 90-year-old has the financial capacity to have a much larger percentage in stocks than a 65-year-old.
Well, we've talked about that. We've talked about how as you approach retirement, let's call it age 65,
the 65-year-old very well has a 30-year distribution time horizon.
Mm-hmm.
It's unlikely the 90-year-old has a 30-year distribution time horizon.
No, and if they do have a 30-year distribution time horizon and they do somehow live to be 120, they'll be all over the news and they'll have people paying them. They'll be okay. I'm kidding. So bonds, obviously bonds fluctuate in value. And this is what we're seeing right now. We're seeing this where bonds, when interest rates rise, and they've risen dramatically, it can really cut into the value of your bonds. So is there maybe some alternative that people should consider?
Well, managing your portfolio may be a little bit different. Instead of using bond funds, bond funds typically, if I own a bond, I bought a bond a year ago and it matures in 5 years.
Like a treasury?
A treasury, a corporate bond, as long as it's a good quality bond. Mm-hmm. I know exactly what I was going to get when I bought it, assuming it didn't default. And obviously a treasury is not going to default, and hopefully good quality bonds aren't going to default. I know exactly what I'm going to get. And when I buy it, I need to be happy with that, come heck or high water. Especially when interest rates were as low as they were, because you couldn't expect them to go down much to gain and get
No.
But if I hold it to maturity, I know I get my money back. That's if I buy an individual bond. If I buy a bond fund, the bonds internally inside that bond fund, the manager doesn't hold them to maturity. If it's an intermediate fund, as soon as they stop being intermediate bonds, they're sold and the manager buys longer term bonds so that he has an average intermediate maturity. So when interest rates go up and those bonds, he can't hold them to maturity. So there's some issues there. So how you manage your portfolio is going to be different given the fact that we do expect interest rates to still climb, at least from the short term, because that's what the Fed has said they're going to do. And so far they've been pretty pretty
Up
straight
front?
on, very upfront and followed through on what they said. Good, bad, or indifferent. You can debate that all day, but they've said we're doing 75 basis points. They did 75 basis points.
That's an important thing to do.
And so we have a feeling that interest rates, at least from the short side, are going to go up. Now we have an inverted yield curve. So even though they're raising the short numbers, is that going to affect the long-term numbers? And the long-term numbers are a little less than the shorter-term numbers. So it's an interesting situation, but we think interest rates are going to go up a little bit more. How much? That's debatable. But if I'm in a bond that I can't hold to maturity and I'm not happy with the rate on, I've got to expect the fact that I'm going to potentially lose some value in a bond fund that's anything more than a very short duration bond fund, because when interest rates go up, bond values go down.
What happens in a bond fund is that they're purchasing the new ones as they come in, and as the old ones I don't want to.
They don't let them expire.
No, I don't mean expire,
Mature.
but I'm saying when they get to the point where they're
they get down to a 5-year maturity.
Right,
They sell
and
them
they
off
say,
and buy 10 years because they want to keep an
right.
average
So they
of
drop
7,
off the back,
or whatever
so
the number they're
the
using.
new ones come in the front door. The old or the ones
they
that they
sell them
can't
off.
use on the back end, which of course changes the value of the bond fund.
And so they slowly get to the better bonds, but the ones they're holding now may be lower value. Anyway, you expect the bond portion of your portfolio not to keep up with what it has done in the past. Even may not even keep up with average, even after considering the income that it's earning. It may just, if I had 100,000 in bonds, I'm getting my interest, but a year, 2, 3, 4 years from now, I still may only have 100,000 in value because the bonds have gone down in value and I've accumulated some cash.
And that's what's been happening.
And so what's been happening is the cash that I'm accumulating from the coupon hasn't replaced what I've lost in the value.
No, so you're down.
I'm down. And so how do we go about managing against that? Well, one of the things we've been doing or we've seen people doing, are using individual bonds and monitoring them and managing them and buying 1, 2 year, 6 month, 1 year, 18 month, 2 year treasuries and corporate bonds.
Are you talking about as interest rates have come up?
Now that
because
historically
that hasn't been happening.
Well, now in the last 6 months, that's what we've been seeing because interest rates have come up and they're attractive.
Yeah.
I mean, it used to be that a 1 year treasury was what, 0.5?
It was mattress money.
Yeah. Now it's 4.5. 3, 0.8, whatever the case. It's in the 4 range, give or take. Now the question is, how long do you buy your bonds? Because after you get past about 3 or 4 years of maturity, they start coming down a little bit. Your yield to maturity is better at 1 and 2 years than it is at 5, 6, 7, 8, 9, 10 years.
Isn't that interesting?
And so the bond market is saying we don't expect inflation to last forever. We don't expect these high interest rates to last forever, but we expect them to last for a couple of years. So do you, if you've got a 5-year time horizon, do you buy a 5-year bond and just hold it to maturity, or do you buy a 2-year and hope that in 2 years the interest rates are similar to what they are today?
Do you have an answer to that question?
No,
or is
I don't
this
have
just
one.
the hypothetical
that's
that
a hypothetical.
That's what you have to play with. This is what you have to consider as an advisor yourself.
That's what we're playing with. And so how long do we want to lock in? If you say, look, I don't want to have to worry about this. I want to know for a fact what I'm getting. And if I can get a 4.5%, I'm not sure that that's the exact rate, so don't hold me that. For 5 years, I'm taking it. And I'm just going to lock in and I'm not going to worry about it. And if I'm buying an individual bond, an individual treasury that's going to mature, I know I get the 4.5 and I get my money.
So even if the interest rates go up.
In the meantime, my value may fluctuate, but I know what I'm getting. And I know that I can hold to maturity. So I'm either using individual bonds or I'm going to go back to that horrific annuity word.
Well, that's where I want to go with this too. And I want to talk about that.
I can use annuities, fixed annuities, to lock in rates of return for X number of years, 3, 5, 7 years. And they are locking in somewhat attractive rates.
Instead of a bond,
Instead of a bond. Now,
can you, I'm sorry, go ahead.
The difference is one is guaranteed by the U.S. Treasury. Treasuries are that. Or it's guaranteed by a large corporation, a corporate bond, versus a large insurance company guaranteeing your principal. That's a big.
That's the big difference.
Well, that's one difference. The other issue is if you're buying it with personal money, the annuity is potentially tax deferred, whereas the interest that I'm receiving on the bonds for the 5-year
is taxable
when I receive it.
Right.
I mean, so there's good and bad points to both of those.
Okay, so you mentioned fixed index annuities or fixed annuities, whatever it is. Fixed annuities, different types that there are. Can you just explain for people who have heard of them but they've heard bad things, or they've heard of them, they don't even know what they are? How does it work when you're using it as a bond alternative?
Well, if you're using it as a bond alternative, you're using a fixed annuity or a fixed index annuity. The key there is the word fixed. It's fixed. I mean, the principal is guaranteed. The principal is guaranteed by the insurance company. You are not investing in any particular security or something. You're investing in the general account of that insurance company. The insurance company is saying, we guarantee your principal and we're going to pay you interest. How much interest? That's either stated as a multi-year guarantee of interest or it changes every year. Personally, I don't like the ones that change every year because maybe I'm a control freak, but I want to know what that insurance company is going to give me, and I don't trust anybody. I want to know. So I want the multi-year guarantee, and I want the multi-year guarantee to match my surrender charge, my surrender period.
And the surrender period
with an annuity, you put money in it, and to get the better rates of return than what CDs pay, the insurance company wants to know they have your money for a specific period of time.
Like you're not going to sell it all, get rid of it.
I'm not going to sell it within the next 3 years, 5 years, 7 years, some period of time. If I do sell it within that surrender period, there's a contingent deferred sales charge, a penalty for early withdrawal,
yeah.
A slap on the wrist, more like
well, it hurts. It's going to hurt. It's going to cost you. You bet.
Yeah. CDs have similar things, but the annuities have bigger ones.
Sure, of course.
And so as long as I'm okay locking it in for that period of time, I can usually get a better rate of return. Now, the big rub on annuities, and this is what everybody that doesn't know what they're talking about, complains about all annuities, is that their fees are just draconian. They're just astronomical. The fees. Well, when you buy a fixed annuity, there are no fees unless you get out early. So you get what they say. If I put in $100,000 and it says it's going to pay me, I saw one the other day for 4.85% guaranteed for 3 years. I will get 4.85% for 3 years. No better, no worse. That's what it is. And assuming I stay in for the surrender period of 3 years, that's what I get. There's no charges, there's no fees, there's no expenses to the investor. If I get out early, yeah, there's a charge. But so that's what it is. Now, the fees come in different kinds. So I'm not saying that all annuities don't have fees. No, some annuities have exorbitant fees. The fixed annuities don't. It's all built into, I mean, what's the fee on a CD?
Well, it's baked into the rate.
Exactly.
Right?
Same thing with a fixed annuity. So you have fixed annuities. I like the ones with multi-year guarantees that match a surrender period. And right now they have, you can get 3+ year lock-ins, all the way up to 10, 12 years. I don't necessarily want to lock in that long.
Well, what happens when you talk about these, the type that you're talking about, the multi-year guarantee, and there are different types. But what you're talking about is you're saying, I'm locking in this rate. I'm happy with this for the next X number of years, 3, 4, 5 years. I'm going to lock it in. I know what I'm going to get. Now, if interest rates fluctuate the way they have,
right,
that's not going to change the...
Well, because unlike a bond that's sold
rate
on
of
the
return.
Secondary market,
yes,
and the value of the bond goes up and down with interest rates, and it shows up on your statement. Even if you hold it to maturity, the value goes up and down based on interest rates, and you have to understand how that works. But with a fixed annuity, there is no secondary market. You don't see any of that fluctuation because your money is with the insurance company.
Mm-hmm.
You know exactly. You'll see the surrender period. You see the surrender charge if you try to get out early. But other than that, it's just you're earning X% guaranteed on whatever the contract says.
Again, guaranteed by the insurance company.
Guaranteed by the insurance company.
So you got to pick a good insurance company.
Yeah, we're not dealing with shifting sands.
Shifting Sands of Idaho or whatever it was.
I think it was. But,
whatever it was. It began with an I. So I mean, it sounds to me like, as I'm trying to put this from the perspective of the listener who doesn't understand what this is, it sounds to me like it's a type of, that it acts like a bond. It's not a bond, but it acts like a bond, but is not affected by the interest rate environment.
Yes, and it's a way to, it's kind of like laddering bonds, individual bonds, but you have a bigger pool to work with, and you know exactly what you're getting, and you don't see the volatility, you don't feel the volatility, and we've seen bucket number one, money we're going to spend in the next 5 to 7 years. Cash and money markets for year one, a 1-year treasury for year 2 and 3. And then in year 3, we have a 3-year fixed annuity that kicks in and pays out. If I needed $20,000 a year. It matures for $40,000, and I've got year 3 and 4. Then we have a 5-year, and each one gets a little bit better rate of return. And the fixed annuities typically pay a little bit better than the treasuries and or other individual bonds.
Now, if somebody
better
had
than CDs for sure.
Well, so if they own one of these, let's say, and they use this type of fixed annuity as a bond alternative, if somebody owned one of these things, and the market dropped, in essence,
well, the market has nothing to do with it.
No, I understand that, but the market dropped. Their rate of return, overall rate of return, if it had done what it did here in 2022, their overall rate of return would have been better than if they'd had bonds. Because
my rate of return would have been, if I had bought.
I mean, their overall between the stocks and
the 3-year rate a year ago was probably 1.92%. And so the market goes down, bond market goes down, everything goes down. My fixed annuity that about a year ago is, I put in 100. It now shows 102.
Right. So there's the cushion. That's what I'm saying.
Yeah, it didn't go down at all.
So that in that instance, this is why we're talking about this, because they would have been better off. The bonds did not provide any kind of safety net, really.
No, they didn't. And they also didn't provide very much in the way of yield.
Right. Well, of course not. Yeah, absolutely. That's the other part of this. But assuming you're just buying this maybe for the safety net and whatever, you don't want it to fluctuate, this would have been a better alternative.
In many cases, yes. And so, and we have
given
been,
these circumstances,
it was hard to get excited about a 2-year or a 2% 3-year guaranteed rate. Although if you compared it to CDs a year or two ago, that was a very good rate.
Excitement is relative.
Yeah.
Okay, 3 years on a treasury or 2 years on a treasury, what were you getting there?
1.7, 1.6.
Yeah, 3 years on a CD, what were you getting?
About the same.
Yeah, so 3 years on this type of
it was a little bit better.
Insurance product was a little bit better.
And the same thing works now. 2-year, 3-year treasuries are 4.3ish, 4.4 given the day, and you can get maybe 4.8 on a 3-year.
Yeah. And please understand when you're listening to this that these rates are changing constantly.
Yeah.
So it just happens to be when we're talking about this.
But normally the fixed annuity is slightly higher than the bond alternative that it's replacing. You're trying for similar maturities and comparing similar maturities, and normally the fixed annuity it's not going to be double, but it's a little bit more than what you were getting on the other side.
And it's not subject to the interest rate.
No, it doesn't. You don't see any interest rate fluctuation in value.
So I wanted to hammer that home, but I wanted to bring this point up on this particular episode of the podcast because people who have held bonds, over the years, if they're looking at their bond portfolio and they're saying, my goodness, if I had to sell this today or whatever, if I want a better rate and I got to get rid of these, I got to take a real bath on this.
If you sell a bond early, yes. But if you sell a fixed annuity early, you're taking
I understand
a big
that.
hit too.
I understand that. But I mean, even if it's FOMO, you know what I mean? Fear of missing out.
Okay.
I have all these 10-year, or I have 5-year. They have 5-year trade. They have the 5-year. Sure. Yeah. Okay. I forget what income they have.
And you can have a treasury in pretty much any monthly maturity you want.
Because that's true.
Most of the time you're buying them. You're not buying them from the treasury. You're buying them on the secondary market.
Exactly. So you can get them. You can get them. And I don't want to get into yield to maturity and all that other stuff, but it's all priced in, so that it's not subject to the interest rate fluctuations.
Right. And if you are looking for a little bit longer, maybe a 5+ year time horizon, you want to maybe and take a little risk on the return a little bit, not on the principal, but on the return, you can go to a fixed indexed annuity. And again, the majority of fixed index annuities do not have any fees. And so what a fixed index annuity, unlike the multi-year guarantee or the traditional fixed annuity that tells you what it's going to pay you for the next year or for the X number of years that the rate's going to be guaranteed, you're not exactly sure what your interest rate return is going to be on a fixed index annuity because the return is based on a calculation, the movement of an index. The S&P is most common. Russell, EFA, some other indexes are out there. And so they look at it over, and there's a formula for determining this. Probably the most common is an annual point to point. They say contract date, the S&P is X. What's it going to be a year from now? They look a year from now, years past, they look at it. Is the S&P higher or lower than it was a year ago? Mm-hmm. If it's higher, they calculate how much higher. 5% higher, 8% higher, 10%, 20% higher, whatever it was. And you get that return subject to a cap. So if the cap is 9% and the S&P is up 5, you get 5. If the cap is 9 and the S&P is up 14, you get 9. You're capped on that period. Now, there's a bunch of different strategies. This is where the complications of fixed index annuities come in. There's lots of different ways to create these strategies for creating interest. But the principal is not in the index. The principal is not invested in the market. The principal is in the general account of the insurance company that the insurance company is guaranteeing. So they're guaranteeing you the principal, and they're saying, we will pay you interest based on this formula, based on this index. And then once the interest is paid, if you get interest, it becomes part of your principal. So you can't lose what you've already made. So the fixed index, and right now caps are in the 10 range, give or take, on an S&P point-to-point annual. So we're down in the market. Yeah. Doesn't mean we won't go down further, but we should start seeing hopefully some upward movement. And so you could put in an account and say, I want to put in money into this fixed index annuity. I'm going to use that S&P point-to-point. And like I said, maybe it's got a 9 cap or a 10 cap, an 8 cap. A year ago, 2 years ago, they were in the 4% range for caps. And then they were 8s, and now they're 8s and 9s. And so you can say, I'm not risking anything. Now, if I invest in the index itself, I could get a much better rate of return, but I have no guarantee, and I could lose money.
Well, you can't invest directly in the index.
Well, you can invest in an index ETF. And
right. That's what we mean. I just want to be clear. So
this is a way to try to get a little bit. Now, the reality is over a 5, and usually they're 5+ year contracts. So over 5 years, you expect 1 year, maybe 2 years of negatives, and 3 or 4 years of positives.
No guarantee,
but you figure you can get probably 6%,
maybe
blended return over the next 5 years.
Well, the point on that though, Professor Plum, is when you get into the fixed index annuity, there are complications. I mean complications. It gets complicated.
Well, the strategies get complicated,
and you really need to know what you're buying. And I think it's imperative,
because insurance companies are very good at making you believe that they've got your best interest at heart. I'm sorry to say it that way.
There isn't a single.
But they've put together indexes. They're risk-managed indexes, risk-controlled indexes, these balanced indexes, and they're just basically never going to earn you any money.
Well, that's what any company's going to do. They're going to say, look, I am really looking out for you. However, if it comes down between me and you, it's going to be me. I mean, that's the nature of that's the nature of
so
business.
I always look at what's the worst that can happen.
Absolutely. Yeah.
When it comes to working with any company. What's the worst? And if the worst is acceptable, the only thing that's going to happen is I'm going to be acceptable or better.
So as we wrap this up, what are your just overall thoughts of using fixed annuity products as a bond replacement?
We've seen people move away from the typical balance fund and go towards more value-oriented stocks. They figure, well, the risk is about the same on the downside, at least it has been this year.
Right.
And then going to more fixed products, individual, hold-to-maturity type products on the bond side. So they're not managing it as one pool where the cash flow from the bonds is being used to buy stocks and balance it out, rebalance it every quarter, every month, every day. They've kind of separated those two a little bit and saying we're going to do it a little bit different because we have better upside with this, similar downside, and then we've got no downside with this, but a fairly stable rate of return.
So you like it?
I like it.
There you go, right there. I like it. He likes it.
Hey, Mikey.
Mikey, he likes anything or whatever it is. He hates everything. You heard it here. I just wanted to make sure people understand that there are alternatives. And as interest rates come up, it seems like a lifetime. And for some people, it is a lifetime since we've seen, the average 10-year was 5% for ever.
For a long time.
Right. And
until it wasn't.
That's what the norm was. And now the norm is somewhere around much lower than that. So interest rates seem high right now, but they are certainly high. They may not be high they're not high historically. In fact, they're a little bit low still historically.
Yes.
But they're high compared to what we're used to, and that's the short term of it. So
that short term is 10, 15 years in this respect.
It really is. So, is there a new normal? I don't know going forward. But there are alternatives to this, and I think you should at least maybe look into it. Talk to your advisor. Professor Rick Plum and any of the Lucia Capital Group advisors, they do this stuff every single day. They look at this very carefully. They enjoy it. I don't know, but they do. I guess it just takes a certain type of person.
It takes all types.
There are people who enjoy calculus. Why, I don't know.
My son-in-law is an engineer, and he's really good at that stuff, and how you look at it. And
I don't want anything to do with it.
Boggles my mind.
Although I did enjoy analytical geometry in high school. I got to say, that stuff was fun. Working with ellipses and parabolas and hyperbolas and That was fun. But anyway, okay, so
And people think I'm weird?
everybody's got something they enjoy that's strange. If you want to learn more or have questions, you can talk to the folks at Lucia Capital Group. Give them a call, 800-644-1150. As I said, they do this all the time with their clients. They can help you out as well. Maybe you need a review. It's probably a good time to review and say, look, you know what? Maybe this isn't working out so well. Maybe we can try some alternatives. 800-644-1150. You can also learn more at luciacap.com. The website, luciacap.com. Go there. And don't forget, hey, we got one more broadcast for this season, one more podcast for whatever season this is. I've lost track. But anyway, and after that, we'll be taking a break over the holidays, the 2022 Christmas holidays. Then we'll be back again in 2023 with more guests and all that stuff.
2023.
Yeah, I know.
We're already saying 2023. It's right there.
It's ridiculous. I don't even want to talk about it. But we will be doing that. One more. In fact, next week, I believe we're going to be talking about pensions and how they may affect your Social Security payments. We haven't talked about this for a long time, and I want to sort of get back into that. So, Spotify. Go to Spotify. You won't miss a single episode. You'll find our podcast there, Managing Your Financial Future. Subscribe or do whatever you have to do to get it to download and become a regular listener. Out of time. We appreciate you listening to us. For Professor Rick Plum, CFP, I'm Johnny Dean, your podcast host. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Fixed indexed annuities are complex, long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider exchange-traded funds, investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Before investing, carefully consider a mutual fund or an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Russell 2000 Index is a small cap index consisting of the smallest 2,000 companies in the Russell 3000 Index, representing approximately 8% of the Russell 3000 total market capitalization. An investment may not be made directly in an index. MSCI EFA Index is a stock market index that is designed to measure the equity market performance of developed markets outside of the U.S. and Canada. It is maintained by MSCI Barra, a provider of investment decision support tools. The EFA acronym stands for Europe, Australasia, and Far East. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.